Okay, well, it's now August, and we're excited to give you another update from the team. Let's see, we're going to hear from Tony with a market update. Zach's going to give us an update on the GIPS performance project that he's been working on. And uh, you guys also can utilize the chat bot or chat function. If you guys have any questions while we're jumping through this presentation, then we'll finish up with a Q&A and we'll answer all of those. We are currently at 1 billion, 1.37 billion. So thank you all so much for your continued business with us and just helping us grow. We really appreciate you all. Tony, let's have you kick it off.
All right, sounds good, Sam. Let's jump into the first slide. All right, I'd like to start off with just what are the most used, the highest AUM models on the TAMP, and that are SPL. And if we take the top five of those, which is sector rotation, Delta Calendar, StarPath, Synergy, risk managed gold, and breakaway stocks S&P 500, we can I put those into the portfolio toolkit to create just kind of a simple blend of kind of a law of large numbers type portfolio of what do we get when we do that. So next slide, please, Sammy. We get a pretty good blend, actually. 20% into each one yields a blend that has a CAGR of almost double just the benchmark S&P, and with a max drawdown of quite significantly less. So that's just a real simple, quick kind of exposure to the tools that we provide, and the risk management that's available for everybody to develop at their leisure. And all right, next one, please. So this shows we have a pretty decent outperformance on the upside, but again, as I always stress for myself, I'm always looking at risk, and so the max drawdown is always what I focus on whenever I'm looking at any models and blends and indicators. I've been doing this long enough to realize that regardless of what people say their risk tolerance is, they generally can often be the first ones to bail out when things aren't going their way. So I try to keep max drawdown roughly less than 25% whenever possible. All right, next one, please. Current state, all of our indicators, well, that's a typo. All of them except one are on buy signals. StarPath is still out. And yeah, okay, next one. All right, so the one model that 100% focuses on StarPath is the buy replace plus StarPath. And just, we've gotten, it was Delta V a little while ago. Now we're getting a lot of concern about StarPath. And what's kept it out so far has been really small cap value. The small caps is what triggered the sell signal. The small cap value has been rallying the last couple of days pretty significantly, so we'll be keeping a close eye on that. But I think it's important to always be looking at the long-term view of an indicator or a model. And in this case, pretty handy outperformance, and once again, max drawdown is kept under control. Next one, please. Again, we're talking about IJS. When you look at the chart of IJS, it's been flat since 2021. And if you look at relative strength between like the Mag 7 denominated indexes and small caps, there's just been a really glaring outperformance of going into tech. And so now we're seeing a pickup where small caps are starting to participate, and we'll just see if that continues. Next. From some S&P levels, the S&P is at all-time highs. 640 was broken. This slide is actually a day or two ago. And so now we're up above any sort of resistance and clear blue skies anyways. But now, of course, the argument becomes of at what point do we become overbought or not? Next one, please. VIX still is below 20 as long as we're below 20. It's above, really the better way to say it is above 30 is a hazardous time to be in the market. So as long as we're below 20, things are nice and calm. Doesn't mean it's going to stay that way, but we should all be able to rest a little bit easier with VIX below 20 anyway. Next one. I talked about this one before, but I'm bringing it up again because I think it's important. The concentration of the top 10 names of the S&P 500 is the highest it's ever been. It's actually almost double of what it was during .com. So if anybody remembers .com like I do, it was a massive blow off top. The internet was going to change the world just like AI is, and we all know what happened next. So definitely something to keep an eye on. There are some risks out there. Next one. It's a couple of slides here on the narrowing of the market. This is S&P 500 percentage of stocks in the index that are above their 50-day moving average. Saw some nice participation earlier in the later spring and summer, but that's fallen off to where it's just a little bit above 50% or in a short-term uptrend according to the 50-day moving average. Next one, please.
Tony, just real quick, looking at that last chart,
Yeah.
am I reading it correctly that it starts to fall off around July? Like,
yeah, I would say that was probably middle of last month. Yeah.
cool. Thank you.
Now looking at the Dow, we see the Dow is actually kind of consolidating here, even maybe slightly pulling back a little bit. S&P 500 is hitting new highs, so keep that in mind as we look at the next chart. Sam. All right, mid-cap 400 is also consolidating, and Russell 2000 is pretty much flatline. So not everybody is participating in this latest rally. So I think that's important to know. Next one. So where are we now? The rally is flattening, possibly, even though we're at new all-time high in the S&P. Participation is narrowing. I think it's pretty obvious. It's not a sell signal. That's normal behavior for markets to expand and contract, but it's definitely something worth knowing and to keep an eye on. Markets don't move in straight lines, but we continue to see a steady upward trend in the major index, really major index, I guess I should say, S&P 500. And with the weight of the evidence approach, 3 out of 4 of our main equity market indicators are positives, suggesting we remain in a growth-oriented environment, but not aggressively so. And that's all I got.
Awesome. Thanks, Tony. Zach, you ready?
Yes, sir. So as you well know, I've been working very hard to get composite performance data that you can share with your clients, as a, way to try and get them in the door saying, hey, this is what we've got. And so we're going to first start here looking at year-to-date numbers. Obviously our biggest carry for this first 6 months of the year has been gold. Looking back, there's been a dramatic rally in gold for this last 6 months. And that next step are some of the more passive buy and hold strategies. And then we're starting to see, as you can flip to the next slide, you'll start to see the harmony models are the next thing to go, which once again, something like a harmony 4, and this is by inception to date, has such a strong performance due to this rise in being in the market, due to having a neutral position in something like buy or replace. you don't understand what that necessarily means, feel free to reach out to me, reach out to Sam. We are happy to walk you through any of that. I want to go back to that previous slide from Sam though. So yeah, so we have, for year to date, we're up to almost 25% for the risk managed gold, and then we got the passive and actives doing quite well as well, sitting around that percent. And then we got some bond and our momentum growth portfolio. And moving over now to the inception to date information. You want to hit the next slide for me, Sam? This is where we see both golds start to show up because we have different gold models. Then Harmony 4, and then some of the familiar suspects. It's worth noting that we have strong performance in the long-term history of things like our Delta V calendar star path, but due to how defensive they've been with some of this market volatility, it's not showing up in such a short time frame. Yet, looking in the long run, it is still very apparent. And that is all that I have for you. Feel free to ask me questions on this or the process to get this to have something to hand to your prospects. Let me know. We'll get to that at the end of this meeting. Thank you.
Thanks, Zach.
And
all right, I want to jump in real quick. I've had some questions regarding the model blends, what to expect during different market signals. Now, obviously, with the star path being negative, that does have a significant impact on a lot of those blended strategies. And so I'm going to go ahead and share my screen and just pull up the blend page in your command module. Let's see, share. All right, so in the marketing page, you can scroll down, and on the right, you'll see the Starship asset allocation strategies. You can go ahead and click on that, and you can see the lineup of from tactical plus alternative, and then on the last page, adding the hedge fund light with the synergy models. And down below, you can see the model blend construction for those. There's another page to the right that'll actually show you the model names associated with each one of those model codes that it's referencing. So you can reference that for context. But I want to just zoom in on this. Let's take a TAH growth model, for instance. When we look at the blends here, these have been optimized to hit specific targets with max drawdown, CAGR, and risk score. And they were not necessarily optimized for diversification across every single market signal. And you'll see that if you take a look at these models with like breakaway S&P 500, sector rotation 2, synergy model, breakaway Russell, and the synergy GI, these all utilize the star path indicator. And how this then impacts the model is when star path goes negative, significant portion of the portfolio will go defensive and typically follows calendar effects. And so like right now, for instance, with calendar effects being out of the market, your portfolio would largely be sitting in cash right now. And so something to consider if you're navigating client conversations, you can consider utilizing other portfolios, either active and passive models, or just adding some other models that utilize some different equity indicators like Galactic Shield or the Starflax indicators to provide some additional diversification in the signals so that at any point in time, you're not necessarily all in cash following one signal. And so I just wanted to go over that quickly. If you have any specific requests or want to dive into that more, we can always circle back. You can reach out to me and we can dive in further to consider what other models you may want to include. So with that, anybody have any questions? We have a question from Cliff Rebello. When will you have the shield models added to the portfolio explanation doc?
Yeah, I don't know.
Zach or Daniel, do you have a?
Oh, yeah, I don't know what document it was named. I missed when you brought it up, I missed the name of it, but I think you know what I mean.
Oh, sure. We don't have the shield models added to that model list. That is a good takeaway. Research team, do we have an ETA on when we think we could have those added? Or is that even in a current project?
It's not a current. We should get that updated. So before the next meeting for sure.
Okay, great.
They have more of a comment than a question, I think, but maybe it goes both ways. You can't add an additional model to a blend account with the blends, correct? So it has to be either a separate account or you have to split the blends up, which isn't recommended, correct?
I wouldn't say that it's not recommended. What it's called is it would be called a custom sleeve strategy, where when you're submitting your trade instructions, instead of putting in, TAH moderate, you would just reference that page and you would put each individual model in individually. And so we have some of the advisors that'll do that. Let's say they want to overweight one of the underlying models. You just submit what we call a custom sleeve strategy for that. And that's how you'd go about adding further diversification. Let's say you have an account that's currently allocated to like TAH growth. You would submit a new trade form that breaks out the individual models, and it would be one model per sleeve, and then add those additional models.
Yeah, I reminded our team that it's important that we keep track of those as you guys make changes to the blends. We have to then go back in and adjust those as well.
Yes.
So that can be a little bit bigger.
The one other piece, which if you're going from something that is like an already offered blend on our side, making sure that when you add that change, to then tell Orion that, hey, this is no longer exclusively following this strategy, because I've seen Orion fail to remove the, like, let's say TAH moderate tagging from something when you're going away from that strategy, and then that causes problems downstream as well.
Yeah, so you could make a
is
simple note in your trade instructions to remove the sleeve strategy and replace with a custom strategy, and then list the target allocation.
the simplest solution that's going to have the least maintenance going down the road is any additions would be put into a separate account. So you have, you open up a second IRA and then put your active and your passive and your, any loose models. Let's say you want extra gold as those pieces of the custom sleeve strategy in a separate model. And then you don't have to worry about updating the blend if it ever changes. And you don't have to worry about Orion mistagging it.
Yeah. We are close to the finish line with the OA form transition. One thing to keep in mind, just a kind of a housekeeping comment, for any firms that are still in process for getting accounts switched over from the Town Square manager over to Sherman. come the turn of the month in September, right around billing season, and we'll talk about this next month as well. We're just going to put a hold on any transitions between those two masters or managers 2 weeks prior to the turn of October, and then two weeks after, just to make sure that that our billing team and the billing processes can are uninterrupted. And so we'll talk about that again next month, but just so you know, that's important.
If it's of interest, I can also go through in a little bit more detail some of the models that we have as timing diversifiers, and what the effect of integrating some of those with our main TH models could look like as far as performance effect. I have a couple of mock-ups of that.
Yeah, that'd be great if you want to show that.
Okay, I'll share my screen.
Perfect.
All right, so here you can see we have the active and passive models that are fundamentally screened, and they have very low trading frequency, usually less than once per year. As it takes 2 quarters for for any of the funds that are in there to fail and need to be replaced. So there's a minimum of 3 quarters, and usually they are in there for many years. Then there's the Pinkerton Wealth tactical models, the income and growth, high dividend portfolio, and momentum growth portfolio, which all use different indicators and different mathematical foundations than the rest of our tactical models. Then there's the single indicator models. If you want to increase exposure or decrease exposure to specific indicators, there's Delta V by replace with StarPath, calendar effects, long cash, and the sector rotation. That's sector rotation 1, not sector rotation 2, with the indicators that they would increase exposure to. And then there's also the star models, which use galactic shield for the in market, and delta V bond for the out of market positions. And those have a range split, so they always have some, except for the star 100, they all have some equities and some bonds. And then there's the alternative models, so the risk managed gold and risk managed energy models. And so if for a client specific needs, like, maybe a client wants some consistent market participation across the board, then adding some active and passive is going to make it where they're never 100% out of the market, especially if they like to track how they're doing against the S&P 500 or something like that. And then the high dividend and income and growth models can give more flexibility for income consistency and lower trade frequency in tactical models. So what this can look like, and given that most of those are not integrated into the portfolio toolkit yet, it's somewhat challenging to model them, but I was able to add in some of the active models using proxies, because based on their current portfolio, to model back what it would look like to 2005 approximately. And so you can see that the effect of adding in a 25% slice of a correlated active model, so in this case for the moderate I put an A50, it drops the overall performance a little bit, as well as the maximum drawdown. And then but it reduces the reliance on the Delta V calendar star path model from 61% as far as the indicator combination goes, down to 40%. And that's for the max in market allocation. And then for the max allocation in any configuration, it reduces the dependence on delta V and star path or calendar for the out of market from 100% down to 75%. So there's less timing correlation by making that addition. And we can see the same thing then with the growth and the 880. We have a slight reduction in performance, as well as a slight reduction in maximum drawdown. And then the aggressive, adding in 20% slice of the A100. And then once again, we have a reduction in the correlation to the percentage of the model, or percent of the whole portfolio that's then moving with delta V calendar star path, which is the predominant indicator set in these blends. And then you can see how that stacks up against the 80/20 benchmark and the S&P 500. So that's all I have there.
Awesome. Thanks, Daniel. Yeah, it's really important that you understand what the driving indicators are, especially with the model blends, those sleeve strategies. There can be a bunch of moving parts, and I've had some questions, with the star path indicator going negative, as to why the portfolio is in cash. And so I'm going to share my screen again and just show you how you can go about identifying, using the resources available to you, identifying how the underlying models work, and therefore being able to confidently communicate expectations with your clients, but also when you get questions, how you can field those. And so what you can do is in your portfolio toolkit under SPL models, we have all of the STARSHIP portfolios here. So let's say you're using the TAH growth portfolio. You can go ahead and load that. And it'll give you the breakdown of the underlying models that are utilized in that portfolio. I'm going to go ahead and duplicate the tab here and then jump into the SPL model detail page. And what I can do is I can just go straight down the line and say, okay, starts, we have 22% in the breakaway S&P 500. So we're going to pull up that model. Let's see. Oh, do we not? That's a great example. We don't have the breakaway models in the SPL model detail page right now.
We also don't have the synergy models in there yet either.
We don't have the synergy models.
So for the TA, well, conservative to moderate on TA and T are, you can see everything in there.
You can
but
see everything.
Yeah, but we still need to add the breakaways and the synergy models to that list.
Okay, so I guess I'll just review them here then. The breakaway models, they use delta V and star path as their primary equity signal. So right now with star path being negative, they're going to go to calendar effects with the seasonal equities or cash. Sector rotation 2 follows the same exit strategy. And then the synergy models, those utilize star path as well. And so you can see here, because of that, them relying on star path in that way, that with a negative signal, we'd be sitting primarily in VIL, and then with a positive gold signal, we'd have that 8% gold position. So again, if that is, you have clients that are concerned with that, definitely reach out to us and we can help you reevaluate your sleeve strategy there to be more suitable for your clients. All right, any other questions?
I have a clarification on the comparison slide that I showed that I forgot to highlight. I'll just share my screen again really fast so you can all see it. So the fee you'll notice between the TAH moderate and the one with the A50 is a lower fee, and that's the adjusted fee because the active models have a lower fee, a 35 basis point fee, as opposed to the tactical models. And so the net effect of putting in that slice lowers the overall fee. And so that is another benefit towards to mixing that is if you have a client that is concerned about fees, by putting in a non-tactical slice, that can also lower your fees.
Awesome. All right. Well, please reach out to me at any time or any of the team. If you have any questions, we're here for you. And just thank you so much for your continued partnership with us, and have a wonderful month. Good to see you all. Bye-bye.